This is Robert Kraft, and I'm your host for the Planet MicroCap Podcast. And we have a very special episode for you all today. We have two guests from the same firm, two guests, one firm. And real quick, just wanted to remind everybody that you can follow Planet MicroCap on Twitter at Bobby K. Kraft, and go find us on iTunes, Stitcher, Spotify, all those. You can go and listen to this podcast on any of those. So now, like I said, join me today. Two guests, one firm. Joining me is Gary Ribe. He is the managing partner and chief investment officer at Accretive Wealth Partners, and his partner, Eric Furey, managing partner and wealth advisor at Accretive Wealth Partners. I met Gary, I believe, at an investor conference a couple years ago, and I thought it would be fun to learn more about his and Eric's investment philosophy and a bit more about their firm. So with that, guys, welcome to the Planet MicroCap Podcast. How you doing today?
Doing great.
Doing
Thanks
well.
for having
Thanks
us.
for having us.
It's great to have you guys on. And first things first, just have to, I really want to ask, how's everyone holding up? How's we staying safe and everything? How you guys doing?
Doing our best to stay safe and stay sane in sort of these crazy times. Eric?
Just taking it day by day. Every day seems like a little bit more change, and just try to take it all in stride. But yeah, everyone's safe, everyone's healthy.
I really, we were talking offline, we all have kids now, young kids. I mean, I feel like we could do a whole podcast just on, how we're, managing work with kids during this time. I mean, we could go off on that. Do you guys want to talk about that the whole time? I have no problem.
It's not enough time for that.
There you go.
I'll just say that I have a great wife that is much in charge of my two kids, and we've got a 6-year-old and a 2-year-old, and certain days it sounds like there's a holy war erupting between the 6-year-old and the missus. And we're fortunate that my 2-year-old does not take after me, because that just would not be fair to her.
I think we can all agree that all of our children probably take after our wives, and we're all very thankful for that. Yeah.
Very thankful.
I was going to say, if anybody hears during this interview, we're doing our little bottle training right now with our 5-month-olds. So I apologize if they happen to hear it. And also, I don't apologize if you're not offended. So there's that. Let's dig right in, guys. As we do on the podcast, love to start with everyone's backgrounds. Gary, first, what would you say led to your passion for investing?
Well, growing up, I was always interested in markets and this, and like I grew up in the 90s, and the stock market was very much in vogue then, and it was sort of unavoidable. And it always intrigued me that if you could do work and do research and invest in parts of companies that you can make your money make more money. And as somebody who just naturally enjoys different challenges and puzzles, and is a little bit of like an ADD kid, the market provides ample opportunities to always be learning and looking at new things. And so, part of what's important to me about, what I do for a living is to constantly be learning and inventing and growing. And, the market just provides ample opportunity for that. And it provides good rewards for that too. And good lessons also if you don't do the right work or you get something wrong.
So what was that first investing experience for you? Was it in high school or in middle school, or college? Like, what was it that you're like, even if it was a loss, like what was that first where you're like, this is really cool, I'm going to keep doing this?
Yeah. So I didn't have any money growing up, really. My parents didn't have a lot of money. We were fortunate that we were not, poor, but we were well off enough that we never had to worry about what we were going to eat. But so that was fortunate, but we didn't have any excess cash or anything like that. So I started just by doing sort of paper portfolios in high school and college. And when I got my first job, I opened a brokerage account, and, I bought a stock because it went down a lot, and I thought, oh, this has to go back up. And that began the learning process. And, the first one worked out a little bit, and then the next bunch did not work out so well. And, it's fortunate that you begin the learning process with a little bit of money, not a lot of money, because the lessons are the same, but the mistakes are smaller in magnitude. So we're fortunate in that respect. But that really kicked off what I would just call the probably 15-year learning process for myself, of just trying to figure out how this thing works, how markets work, how investing works, how what makes stocks go up and down, what makes markets go up and down, and just, you start with sort of the basics, a lot of the basic investing books that almost everybody tends to look at and read, and you sort of work your way out from there. And I was fortunate enough to meet some good people along the way who helped me with that process, and I learned from them. I went and learned on my own, and it's sort of just been this continual learning process. And what's really important in investing is having what I would call a growth mindset. Those people who think they have it all figured out are the ones that usually put themselves in a position to get punished. And so, from where I sit in my perspective, and from how we manage portfolios here for clients and for ourselves and everybody else, we want to have that growth mindset and to always be sort of evolving, because markets evolve as well.
Do you yearn for those simpler times? I saw stock went down and I bought it. I mean, it's just a simpler, anyways, I digress. I mean, I think we all yearn for those simpler times.
So it's interesting as you get experience. So one of the things that I've had to watch out for in my own investing career is you get more experience and more knowledge. You tend to look for problems and situations that match your knowledge level and experience set. And what happens, and what I've learned is when you're doing that, you sort of have to keep the exposure on the relatively modest side, because when you look for something that matches your IQ and your experience set, you're going to encounter things that have at least a 50-50 chance of beating you. And so you sort of have to intentionally try to play down a level or two in terms of the things you're encountering and you're looking at.
I mean, that's assuming that there is a playing field to go to as well. I mean, I'm not saying, what I mean by that is that there's opportunities that you might be looking at that you could take advantage of at that level, right?
Yeah, I think that's right. And, you don't make extra returns with degree of difficulty. So the market doesn't reward you with extra returns for complexity for its own sake. And I know plenty of people who enjoy complexity for its own sake, because this business attracts smart people who are interested in solving problems, and you want to be finding new problems to solve. And sometimes you just have to remind yourself that you can go back and solve the same problems a few times, and maybe just and do just as well, if not better.
For sure. All right, so Eric, let's bring you in here. What led to your passion for investing? And then also, how'd you guys meet to start the firm?
So my passion for investing, probably I'd say it started with my dad back in, say, 5th grade or so. So I've always been one to kind of save money. My parents gave me chores to do. They gave me an allowance. I didn't spend my allowance on anything. I literally just saved the cash and coins in a box. And so eventually my dad just said, hey, there's this thing called the stock market where you could buy interest in businesses. So you could be an owner in various companies. So, what would you want to be an owner of? So I was in 5th grade around that time. And computers were becoming really popular. And so we had this desktop computer. And every time I turned the power button on my computer, I saw a little logo come up. It said Microsoft. And I was like, what about Microsoft? And it's like, you could do that. He said, so for every share of Microsoft you buy, I'll match it. And so I was like, that's pretty cool. So I think I bought 1 share of Microsoft. My dad matched it for me. And so I was kind of a computer geek. And I just kind of kept it for a few years. I watched it all the time, got the newspaper, looked at the quote. Did it go up? Did it go down? Oh, it split. Cool. Now I have 4 shares. And then a couple of years later, he said, okay, so you own Microsoft. What else would you want to buy? And I thought, okay, I see a little sticker on the desktop, Intel. So I bought a share of Intel. Then I think like one Easter, my parents got me a share of Intel too. I was super excited about that. And so that's what I was kind of interested in, is this idea that you could, little old me in 5th grade can own a small interest in such a big company. And that was really cool to me.
I mean, this was the beginning of your dad getting stock tips from you. I mean, let's be real.
I mean, it's just like the very simple, again, it's that simple mindset of like, well, what are you using? The stock market through the eyes of a kid, what's the kid using every single day? And, it doesn't mean that it's going to make money or do well, but, pay attention to something like that. And then, as my thinking kind of evolved, I went through college thinking I wanted to be a portfolio manager, work in the hedge fund space. And then I started learning about being a wealth advisor, and how you could kind of marry the two together, where you marry portfolio construction together with someone's individual goals. They have this money, they want to invest it. What are you actually investing for? What's the purpose? What's the meaning behind the money? And so marrying those two has just been very gratifying for me. And Gary has been a key person in trying to put those connections together for me. So in college, I just reached out to a lot of people in the industry asking to talk to them. Gary helped introduce me to a few people and just got my knowledge ramped up and accelerated quicker than I could have on my own. So super grateful to have met someone like Gary very early on.
All right. So I have like the dumbest question I think I've probably ever asked on the podcast, but I'm going to ask it anyway, because I feel like there's probably people out there who are like, okay, what is the difference between these two things? So I'm going to ask it. Here we go. Dumb question number one. There's going to be more, I'm sure. I'm sure you get asked this also all the time. What's the difference between a wealth advisor and a fund manager?
Oh, geez, where to start? Eric, do you want to take that one? Because I started my career sort of as an advisor and realized I wanted to migrate more towards the portfolio management end of things, and actually had to sort of retool and go to business school and I thought I needed to go to business school to do that and retool and get a CFA charter and all that other stuff. But, there's a lot there. The differences it's night and day. Eric, what you helped me on the investment front. And so you do function in an investment decision-making capacity, but also you're the primary interface with your clients. So I think you'd probably be better suited to answer that question now than I would.
The wealth advisor is kind of translating the decisions that we make in the portfolio in a way that the end client is going to understand. And so different firms have different end clients. Our clients tend to be higher net worth individuals and families. And so, we're not talking about people that have, $100+ million. You're talking about clients at, 500,000 to say $20 million. And so how you talk to those people and everywhere in between, these decisions resonate with them differently. And so being able to translate that in a way that they understand, the way that makes them feel fulfilled, way that makes them feel like they're moving forward with their financial goals for themselves and their family, I think that's probably the key difference. I have worked for a fund manager before. A good day for him was a day that no clients called and he could just look at his computer screen and read and research. That's the opposite of what I want to be doing.
Yeah, I had worked at a hedge fund at one point, and it's night and day in terms of who the clients are and what they're looking for. I would say that we spend, I write all of our quarterly client letters. We do some blog posts. We try to communicate pretty frequently with clients, and we try to do it in a way that is accessible to them. And we're educating them on what they own and why they own it, or what our decision-making process is. And we're doing that. A lot of advisory firms like to, kind of hide what they, I'm not going to say hide what they do, but they act like there's a lot of aura and mystique around it. And, I think, Kurt Schilling once said that those are things that are nice in a nightclub, at a dance club, but, don't concern us on the ball field. Well, they don't concern us either. We want people to be educated and empowered because it's empowering. And the better educated you are in what you have, and the more you understand and buy into the decision-making process, when you have a period of time in the market, like from mid-February to the end of March, it allows you to stick with it. And so a lot of clients ask about what the right investment style is for them. It's the one that they can stick with. And we spend a lot of time trying to educate and empower clients so they can stick with it. And through that period of time, I don't think we had anybody change their investment mix in a material way. And so we, as a firm, and we feel really good about that.
So it sounds like what you guys are providing is also a personalized approach for each of your clients where, depending on what their investment goals are, you're now then going to construct a portfolio or strategy around that. For you guys, is that sometimes hard because, you have your main firm's investment philosophy, but then trying to marry that with what your clients are looking for. How do you manage that?
Yeah, so I'll talk about the tools that we use, which we have individual stock portfolios, which we supplement with ETFs and mutual funds. And I would say that we run a variety of different portfolios to different objectives. It's finding the right objectives for the clients. The tools that we use across the client portfolios are the same. They're just weighted differently based on the objectives. And so the way I look at it is, we've got this portfolio, we've got that portfolio. And when we make changes across all the client accounts at the same time. But the amount of change in each given portfolio just varies based on the client objective. And Eric, do you want to speak to sort of identifying the objectives and sort of how that fits in?
Yeah, I mean, that's kind of more the art than the science in this, especially recently as the markets have run up, people overestimate what the risk tolerance is. And then something like February, March, April happens and people completely reassess the risk and they realize, maybe I took a little too much risk and that was not the right thing. But just being realistic with clients, putting together a long-term plan for them so they understand, here's the money I have, here's what's realistic in terms of my expectations, the return that I could expect to generate. And based on my lifestyle, my needs, can I accomplish everything I want to accomplish? See, a couple months ago, I had a client. He had an account with $300,000 in it, and he said, can I take about $3,000 a month out of this? Yeah, you can, but just understand that you're going to work that account down quickly. And if anyone's telling you otherwise, then you go the other way. And so after we go some back and forth, and we really hone in on, well, what do you actually need the money for? Is this more just for your safety? Is it to pay your bills? Is it, what other alternative strategies should we be looking at? Because if you really need that $3,000 a month and this is all you have, that's a bigger issue that needs to be addressed. And so just spending that time up front with the client to understand what their needs are, what their expectations are, and reconciling those differences early on that's really important.
No, that actually, you alluded to my next question. I was going to come right back to you, Eric, because look, it's been a difficult last few months. You handle the client relationships at Accretive. So, can you go a little further as to what the nature of those conversations have been like and how you've been helping your clients really manage their expectations and new risk assessments as you're moving forward?
Yeah. I would say the credit you have built up in your bank with your clients in terms of how they look at you and value you, it's not going to be built in that couple month time period. It's a lot of the work that you put in up front and before that type of event happens. So typically when a client is asking me a pointed question about the market, the first thing I want to ask myself is, what is this client really asking? And that's when I have to know the clients really well. If I'm talking to a C-suite executive and he asks me, how much cash did we have throughout April, March? I have to answer that question directly. Really what he's getting at is, did we fully participate in the upswing? Were we fully invested, or were we selling on the way down because we were scared and we didn't know what was going to happen? And are we holding on to too much cash? On the opposite end of the spectrum, I just had a call a couple days ago with a widow, more money than she ever possibly needs. She has 60% of the portfolio in stocks, 40% in fixed income. And she said to me, should we have some short-term treasury bills? And I said, this is someone that's a very novice investor. And so right there, something goes off. It says, so what's prompting you to ask that question? I said, well, I was talking to someone and this person used to manage a fund and they suggested this. And so really the root of her concern and her question was, I'm really afraid that the market pulls back again and I'm going to run out of money. It's like, okay, we don't need to talk about treasury bills. We need to talk about that. Let's talk about that and the probability that that scenario actually comes to fruition, and just comforting her, reassuring her that how we got here was based on a longer term, bigger picture plan, and the portfolio can withstand quite a bit, and she should still be in great shape.
Got it. Gary, you want to add anything to
that? No, I've been on more than a fair share of client calls over the past month. because people want to hear sort of what we think and how we're thinking about things and what we were doing and what have you. And I would say that generally speaking, when the sell-off was happening, people seemed to think that other people were panicking and they wanted to see how we were doing. And boy, the phone must be ringing off the hook. And the reality of it was, is the phone wasn't ringing off the hook. We were calling our clients to check in with them. And so people seemed to think it was all the other folks that were freaking out. And that seemed to be the general consensus. Now, the odd thing that I've noticed is that this recovery has been pretty sharp and robust. And we've had a number of clients that are more concerned at the pace of the recovery than they were at the sell-off. And so that's been an interesting set of questions, because, you know, this has probably been the most hated rally ever, because people see the devastation and they see the economic impact, and they don't understand how, you know, the market has come back the way that it has. And so, you know, we had, I think, a different point of view on this in late March, and even we're surprised at how fast that this has come back. We were pretty confident that our elected officials and our Federal Reserve knew what to do, and that things would recover. I think, Eric, you know, if you feel to chime in on this, we are definitely surprised that it's taken just effectively 2 months for a lot of the recovery in the markets to happen. We thought it would take quite a bit longer than that.
Yeah. I forgot about that. It was super interesting talking with clients during this time period, because you're talking to them, and like Gary said, I've experienced pullbacks with clients in the past, and everyone will say, well, I'm concerned, I'm worried, I'm nervous, I think this is going to go a lot lower. This time it was, oh, I'm fine. But man, you must be really stressed. You must be getting a lot of calls from clients. And it just wasn't the case. And I'm not sure why. I don't know why the attitude difference for this. But that was definitely very interesting and not what I expected this time.
So I have to ask you.
We do have certain clients also that are pretty good contra indicators. So as they check in, it's sort of you know, they're wanting to put money to work. They're wanting to put money to work as we're going limit down, and when, you know, they finally get towards the bottom in all this, they kind of want to hold off, and then they're wondering like some. It's funny how just, and they tend to be more watch CNBC every day types. I tend to encourage people to not watch CNBC. And if you have the urge to have it on, just leave it on mute. But some people can't help themselves.
I mean, I was one of those, especially when everything was going down. You almost can't help yourself because it's just interesting at the end of the day. I mean, you know, you're not really listening to what they're actually saying, but just seeing the actual news itself and what's going down. I mean, you know, you can't help but find it interesting, but at the same time, you want to manage your own emotions and your own biases and say, okay, well, what does this mean? Like, how should I react to this? But okay, I wanted to play a little game. Okay, so let's say we're branding Accretive Wealth Partners as America's wealth advisors right now. And let's say you guys, oh yeah, we're doing it. And let's say that we had to make an FAQ on your website right now for all the calls that you've gotten in the last 3 to 4 months here. You know, let's go through maybe some of those most frequently asked questions that you've been getting right now through this crisis, you know. And I don't mean to put you on the spot, you know, and take a second, but yeah, man, let's get some of those. You know, what were some of those frequently asked questions?
Well, it's funny. We did a webinar on March 23rd, the evening of March 23rd, and it was our best attended webinar ever. Normally when we send out a webinar invitation, we get a dozen people maybe show up. And this one we had, 60 people on the call. And it was the best attended one we ever had because everybody's shut in their homes and they're wondering what the heck's going on in the market. And we did maybe like 10 to 15 minutes of intro with some sort of just an overview of what was going on, very, very broad. And then the rest of the call was just carved out for Q&A. So we actually have this. Eric, what were some of the questions that we had that were sort of, because we also didn't see the questions ahead of time. These were people submitting questions. But so these were people's real-time questions while this was going on. I remember certain people had questions about whether this was going to be a wartime economy. I think we had certain people have questions about, everybody had questions on where the market was headed and where the bottom was in all of this.
How long is it going to last?
Yeah.
Should we expect a double dip? That was a big one. What type of recovery is
second wave?
It's in this second wave. People, I feel like they were having trouble separating the virus and the economy and the stock market. I think they kind of lumped all three of them together and assuming that the stock market's not going to recover until we have a solution for the virus, and the economy is going to be really bad. And so how could the stock market recover while the economy is really bad? And so people got really tangled up in that web and just trying to separate it into three distinct different buckets that were loosely connected, but not really.
Right. Yeah, they're really on three different timelines, right? You've got the timeline that's related to the virus, you have the timeline that's related to the economy, and then you have the timeline that's related to the stock market. And there's some relationship and interplay between what happens between those two things, but we were of the general opinion that the stock market would turn before the economy does, because that's generally what happens. It's a leading indicator. And that that may start to, that we were of the opinion that may start to happen once we saw some evidence that the measures that were being taken were working in conjunction with a lot of fiscal from the federal government and monetary from the Fed. And we had monetary from the Fed right away. And so we felt there was a lot of crazy stuff going on in the market in March. There were large ETFs, the most liquid bond ETFs that had the most liquid underlying securities traded, huge discounts to their net asset values, which shocked me. I sat there sitting in my chair staring at my screen going, this is supposed to happen, but it was happening. And so we saw the Fed come in a big way. It seemed pretty clear that Congress was going to get their act together and do something substantial and make sure that we didn't have Great Depression 2. Now, we could still have a depression. I don't know if it'll be great. What made the depression great was how long it lasted. This one, I'm not an economist, so I don't really know. But and then we have so where was I? And then measures, evidence that public health measures were working. And you sort of have to look at these things, in my view, as like a second derivative. And so evidence that this is working is just decelerating case count growth in places like New York City. And so we felt pretty good that we were closer to the bottom in late March than the top, but we didn't know. And so we wanted to make sure that we were not under, so to participate in a recovery, you have to be there when it happens. And we did not want to be underinvested in a recovery. And so a lot of our clients' accounts, if we had a balanced account, for instance, it wasn't half stocks, half bonds, it was 40% stocks and 60% bonds. Well, we wanted to make sure that we got that right. And we were, through the period of, March was the most active time I think I've ever had as a portfolio manager. And that's just, because at a certain point you realize everything, it was a full-scale liquidation, and you could see it. Like anything that was nailed, anything that could be sold was being sold, and there was really nothing that you could do about it except for holding cash. And we did have some cash, but during that period of time, we turned our attention to how might a recovery play out, and how do we make sure that our client accounts were positioned to participate in that. And so if we had a stock in our portfolio that we had questions about, and we were doing a lot of work going through the portfolios to make sure that we had businesses that were primarily equity financed, as opposed to having capital structures that weren't sustainable or were reliant on capital markets in order for them to function. So we were going through doing that, and just I never thought I'd have to stress test certain businesses to see what they would look like with no revenues for a quarter or two. but that's what happened. But when we had things that we had questions about, we wanted to make sure that if we sold it, we bought something that we had fewer questions about, that we felt like would participate in a recovery faster. And so during this, we tried to make sure that we were not underinvested for recovery when it happened, and that we were sort of positioned in such a way, because we felt like the money markets would normalize first, the credit markets would normalize second as the money markets normalized and the Fed stepped in. And then at some point, the stock market would start to recover. And we didn't know when that would be, but we felt pretty strongly that we needed to be there when it happened to experience it. And so we were sort of okay with the idea that we might be a little bit early to the game, but we felt like we needed to hold our nose and do our jobs. And to be honest, you felt a little nauseous hitting the button.
I bet. I mean, this leads to one of my other questions that I had for you guys, actually, was because it was such a quick turnaround, I guess you say. I don't know. Listen, I'll be the second to admit that we don't know where the market's going. There could be a double dip. We have no idea, right? But just based on what we saw right now, I mean, what were you guys doing, and how did you go about managing these portfolios so that you could take advantage of if and when there was a quicker recovery, kind of like what we saw?
Eric, you want to start? I'll chew on that for a second.
At the end of the day, our clients hire us to manage their portfolio to a certain objective. And so, like Gary mentioned, a balanced objective to us is 50-50, 50% in stocks, 50% in bonds. We don't want to be trading too frequently to manage that target objective, because that's just not necessary. But when you see such a wide deviation, we have to ask ourselves, okay, this has happened. We don't like it, but at the end of the day, we have to do a disciplined, unemotional job. And that's what we have to do. And we have to push the button. As Gary went into, there's a lot that goes into how the sausage is made. The decision-making process, evaluating the companies that we have, evaluating the funds or ETFs that we own. I don't know that we talked about any of those things or made any of those firm decisions actually during market hours. Most of that happened offline while the market wasn't operating. And that's what we had to do. I mean, the deviations just got too big and too much changed in the world. We had to get clients back to what their target objective is and what they hired us for.
An awful lot about the mix of what we owned. So the objectives didn't change, but an awful lot about the mix that we did, that we have did. And so, as we went through and looked at this, the U.S. in a lot of ways was not very well positioned to deal with a health crisis coming into it. Hopefully a result of this will be that we'll be better prepared for something in the future. That would be an optimist's view on the fallout. But I can say that I believe that we are uniquely positioned to deal with the economic effects of this. We have the most dynamic economy in the world. We have the best rule of law, the best property rights. The bankruptcy code is an underappreciated part of our system. It's easier to fail in this country and start over again than it is in any other country in the world. And the U.S. has special reserve currency status. It borrows in its own currency at very low rates. And the 10-year treasury is at 70 basis points or whatever it is. To borrow $1 trillion, it doesn't cost the government a lot of money. If you borrow $1 trillion, it's going to cost the government, what does that work out to be?
Not much.
Not much. Not much. It's 70 basis point. My point is, 70 basis points is a really low hurdle rate, even for the U.S. federal government. And so the world wants dollars. We can feed them dollars, and we can invest heavily in the country. And so that changed our view on our mix of what equities we had and what equities looked like. We had a view that this would accelerate certain trends that were already happening in the economy, work from home stuff, but other things too. Other trends that were happening were simply going to be accelerated. Some were going to reverse, and some were put on pause. But a lot of things that were already happening were just going to happen a little bit faster. So the mix of what we owned changed a lot. The mix of what we owned on the fixed income side of things changed a lot. When we read through the CARES Act, that changed our view on corporate credit quite a bit. And so the changes in our portfolios reflected that view. And so it was far and away the most active I've ever, we're not active. We're typically not super active. I like to let the market do its work. I like to let the things that we buy do their work over time. But this was a period of time where so much changed in such a short period of time that a lot needed to be done. And at the end of it, I kind of just felt exhausted, just mentally and physically. And now I'm just kind of bored, because it's sort of like Charlie Munger says, you just have to sit on your ass. And this is a period of time where we sit on our ass. And we're sort of looking at what the next leg of this looks like and trying to see, there are good companies that were disrupted by this, and everybody that has a viable business going into this, we felt like should make it to the other side, and people that didn't have a viable business going into this probably wouldn't and shouldn't. And so now we're spending some time looking at and think about that. But to be honest, there's not tons to do in terms of the client portfolios right now.
Look, man,
Would you agree, Eric?
Yeah, I'd agree. I mean, I'd also add, pretty early on, we decided we're not going to fight the Fed and we're not going to fight the federal government. I don't know what the opinion is of your viewers on Powell, but he acted fast, he acted decisively, he acted in a magnitude that he needed to act in. Then we needed to see the federal government step up and do their thing. And it wasn't until we really started to see them step up and we saw, the rumors of how big is the stimulus package going to be, how big is it going to be, and it kept on getting bid up. And so once you see that, it's like, wow, I think they understand the order of magnitude, and I think they get it. I think we know enough that we could act.
It felt like they were always kind of a week or so behind what needed to happen. And so we saw, an 800 billion package become a 1.3 trillion, become a 2 trillion to finally 2.3. But I think the prevailing attitude in Washington is do whatever it takes to deal with this. And so if the federal government's going to pull out a financial bazooka and fire it at the market repeatedly, I don't want to fight that. And the first shot, well, now we have 2 shots or 2.5 shots, depending on how we're counting it, and they've spent over $3 trillion. And now we're talking about another couple $1 trillion. I think what's going to, my personal view is that they're going to fire one more shot than is absolutely necessary, just for good measure. And so, that's
sure happens.
It's not my job to judge that. It's my job to evaluate it and make decisions. And so we did.
Yeah. Got it. I mean, look, guys, if you're at all, feeling like you got extra time on your hands, you could always come back on here every week. I mean, there's always more things to say. Okay. As we said, we could do a whole episode on managing kids through a crisis. All right. But we digress. But, I also wanted to dig into your guys' blog real quick, because it's a great blog. You share a lot of your insights on there. And you've had quite a few articles during this time period that I thought were very helpful and insightful. So wanted to go over a couple of them with you. The first one is, and it's titled 6 Planning Strategies to Consider in Difficult Markets. What are they, and why are these important strategies during these tough markets? Eric, we'll go to you first.
Yeah. When the market pulls back the magnitude that it did, even if it only pulled back half of what it did, it's really difficult to keep a long-term perspective, and it's difficult to fight your emotions. And a lot of these strategies, you just have to think with a clear mind. So number 1 and probably number 6 are probably the most important. One is reevaluate your risk. This happened. How did you feel during this time? What happened to your portfolio? How did it make you feel? Were you able to maintain rational decision making throughout this? Number 6 was stay true to whatever your savings and investing goals are. So if you have, no matter who you are, So if you're a younger person that's saving, yep, now is not the time to stop. Continue doing that. For some of my older clients, they wanted to say save to their grandkids 529 plans. I had one client that was on a quarterly schedule. They're going to make quarterly deposits into their grandkids 529 plans. The market pulls back. Like, hey, you're going to make these deposits anyway. You have the cash to do it. Accelerate some of those deposits. The market just gave you a pretty good entry point. I don't know if it's going to work out in the short term, but when I keep a longer term perspective in your grandkids' college over the next 15 years, I like this entry point. This is good. So you're going to do it anyway. Now's a great time to accelerate it. Personally, if you have depressed assets and you have a traditional IRA, maybe evaluate converting the traditional IRA to a Roth IRA. You convert it at a depressed value, and hopefully you participate in the recovery. And so all the growth, you're going to, if it's $100, pay goes down to whatever 70. You pay tax on the 70. If you get back to break even, well, now it's in a Roth for that extra $30. And then for some of the bigger clients that are doing some more substantial, complex trust strategies, there's still a lot to do there. And it's really uncomfortable to do some of those trust strategies or LLC strategies, but things that you really need to consider, and you're probably going to be most uncomfortable doing it, which tells you that's probably the right time to do it.
Right. Gary, anything to add on that?
No, I think those are good points. And we mentioned some clients have been sort of suspicious of the recovery, and the question, I had a call with one pair of clients who were like that, and I said, well, to point number one, during the midst of this crisis, did you learn anything about how much risk you were taking? Did you feel like it was too much? Because that's a good reason to do something. I don't know necessarily that being suspicious of the recovery is a good reason to do something, and just really honing in on that. I don't have too much to add beyond. I think those are great points.
So, so just a quick follow up on that, and the, when you're dealing with bigger trusts and just the uncomfortableness of times like these. I mean, how do you manage your own anxiety and stress when you have to have those difficult conversations and say, look, like, this is what we see, this is what we think is going to happen. I mean, at a certain point, you're kind of having to probably take a lot of deep breaths and just like, I hope it does.
Yeah. We're hired to think about a lot of different situations and scenarios for our clients. So I spend a lot of time just thinking about my clients and saying, okay, where are they in this point of life? What are their goals? What are their objectives? How do we accomplish that? And whether the market's going up or the market's going down, or it's just staying kind of sideways and flat. If the market goes down, I would be doing a disservice to my clients if I didn't bring them my best thinking. And so if it's a trust and you need, now I think is a good time to reassign LLC interest, as a way of gifting to your next generation. I need to at least make you aware that that's something that you should be considering. You may not do it, and that's fine. You may think that there's more to go. You may not believe in the recovery. There's 1,000 reasons why you may not do it. And that's okay. But I at least want to get you thinking about it. Not every client's going to do a traditional IRA conversion. Not every client is going to spend continue contributing to a 529 plan. That's fine. But at least they need to understand the pros and cons and that these options are out there for them.
Gotcha. All right. So I want to move now to the most recent article titled The Wall of Worry. So Gary, can you explain to me what that means and if we're still in that wall of worry phase?
Yeah. So like there's this, I don't know if it's an aphorism or a saying or whatever, but it's said that the market climbs a wall of worry. And so, I remember 2009 pretty vividly. And I remember coming out of, the bottom in 2003 and the market kind of coming out of the bottom. And what happens is, there's typically there's been a strong bounce. And then, people who were underinvested or got out they want to get back in. And I remember in '09, there were a lot of people with money on the sidelines because they got out and they were waiting for the right time to get back in. And all the while they were sitting there while the market just kind of started to walk upwards. And there were all these reasons why the other shoe was going to drop. You know, in '09, it was the commercial real estate's going to be next. And, and so in this one, it's the second wave, or it's, which there could be a second wave, I don't know. But there's always some other shoe to drop that's hanging out there. And the people that get out, the more decisions you add to your process, we try not to do any we're not market timers. But the more decisions you add to your process, the more complexity you add and the greater the likelihood that you make mistakes. And so basically it's in my mind, it's kind of similar to '09 in that we have in March of '09, Eric, when did they pass the fiscal stimulus? Was it March of '09 or around that time?
Mid-February. It's like February 18th or something, 19th of 2000.
Yeah. So, I mean, when you have everybody moving one direction on something, sort of the conditions are in place for the market to start to recover. And we could talk about theoretically why, some things have done better than others, but it's sort of, people hate the recovery, but yet the market still goes up. And as I look at my screen here today, let me look at my screen. Hold on. There's a lot of green on the screen. And so people hate this, and the market's not doing what they think it should. It's not doing what the economic data says it should, but it's grinding. And so, and the reason is the market is a forward-looking discounting mechanism. And the minute it can start to look through this, it will. And these are long duration assets. So if you think about a company, having a year or two of down numbers in the grand scheme of things for these companies, if you think about the way analysts go about valuing a company, they'll forecast out earnings or cash flows a couple of years, 2, 3, 4, 5 years, however long they do it. They use decimal points, which means that they're just being funny and they're being overly precise. But the way this happens is, they forecast out a couple of years and then they slap a multiple on the back end. And that multiple, whether it's an earnings multiple, an EBITDA multiple, a book value multiple, whatever it is, the driver of that multiple tends to be growth, some sort of terminal value growth and discount rates. And, a lot of the value of a company is in that number. The next year or two are a pretty small percentage of the overall value. And so, and given how discount rates are falling with all of the liquidity that's being pumped, you might even be able to make that argument that for a lot of companies, that number should be higher than before the crisis. And so, and from a theory perspective, to me, I understand what's going on. I'm surprised at how fast it's happening, but the hardest part of this recovery, I think, is going to be sitting tight and letting it happen.
Absolutely. I mean, Eric, any thoughts on that as well?
I think just generally, if you're fighting what you're seeing in an individual stock or the market, and it's going against what your thinking was or what your expectation was, admitting that you're wrong and reassessing is incredibly valuable. Whether you have cash on the sidelines and you're fighting a market that's going up, or you're invested in something and it's going down, just be quick to reassess what's going on, what you're seeing, because maybe it's not the market, maybe it's you.
Yeah, markets don't care what you think.
Yeah, this is true. I mean, we like to think that they care about it. But no.
Yeah, I mean, I'm part of some investor groups and stuff, and the overwhelming commentary is fairly bearish. And the market's not doing what these people think it should do, or what the economic data, and some people just can't get over whether they're short the market or they, whatever it is. The market doesn't care what they think, and maybe some things are irrational. There are certainly pockets of irrationality out there. I'm not going to dispute that. But on the whole, what's happening doesn't seem insane to me. It's just happening faster than I thought.
For sure. I mean, you definitely have to ask yourself, and it's weird when you see a news thing, coming out across your phone that Ackman's selling out all of his shares in Berkshire. You have to, and then you're seeing the markets up, 600-700 points in the last 2 days, and you're just like, I feel like all of us are just doing that on a daily basis.
Yeah. Everybody gets things wrong, and we get things wrong too. But we just, we try not. I really want to be right, and I want to be right so much that I'll admit that I'm wrong just so I can be right faster. It tend to be the way I think of things. But that being said, there are cases where I'm wrong for some time, and it happens. So
well, you're wrong for some time, and then you're right.
That's right.
Just like I bought,
right?
hey, look, just like, look, I bought the stock when it was lower, and hopefully it was going to go up. I mean, like, things change, right? I mean,
there's certain people out there that are kind of like stopped clocks, and they're right twice a day. So
this is true.
It happens.
This is true. All right, guys, I got to now ask you one of my favorite questions to ask everybody on here as we're rounding the bend here. I know you guys are busy. Well, actually, no, you're not busy, but I'm I don't want to take up too much more of your time. So
Sure.
With that, what investing experience would you say taught each of you guys the most in your careers? Eric, we'll start with you.
I found that with myself, I sometimes was in a rush to get there. And I didn't appreciate the fact that your human capital and your financial capital, if they grow at a very similar pace, probably leads you to a better spot than if, say, there's a dislocation where, say, your financial capital grows a lot quicker than your human capital. You're probably more prone to making errors and bigger mistakes, and that's not a good thing. So just appreciating that aspect of investing. I mean, you could spend a lifetime learning about it and getting better, and you should do it if that's your passion.
Gotcha. Yeah. And Gary?
I'll just say broadly, you asked what's taught me the most. I'm just going to say collectively the mistakes. And I never let a good mistake go to waste. So I've made a lot of them. I've made just about every mistake you can think of. I've bought a stock that looks cheap, but was actually expensive because the earnings were going away. I've bought a stock that, where insiders were doing things that they shouldn't be doing. I bought, and they were mismanaging the business.
But the parts can never be separated.
Some of the parts stories where the parts are never going to get torn apart. Buying something because XYZ smart guy bought it, and he's smart, and we're going to follow that. It's the mistakes. It's learning to do your own thinking. Everything that we're in because we own it. We own the thinking. It's our thought process. We didn't get the idea from somebody else. We've done our own work and our own thinking, and so the mistakes influence the thinking. We try not to make the same mistakes twice. It's hard because sometimes the same mistake has a different face. It's sort of like, or they're kind of like breeds of dog. They're all dogs, but this mistake is a golden retriever and this mistake is a German shepherd. But they're both dogs. They're the same species. They just look different. And so collectively, it's the mistakes. And I try to own the mistakes when they happen, and I try to learn something from them so they don't happen again. And then that just sort of drives being independent in your thought process, and knowing why you own what you own, because inevitably something's going to go wrong with an investment, and if you don't know why you own it, you're not going to be able to. You're going to make even more mistakes with it. So that's what I would say. The mistakes collectively, and those mistakes have influenced me to do my own thinking and to really own my own process.
Perfect. Well, I think we just came up with a new show right there, just called "Investing Mistakes." Stuff happens, And then,
if I was going to teach a course on investing, it would be all case studies, and it would be overwhelmingly mistakes.
Well, I hope we can develop that very shortly, because I think that would be really fun. So with fun and also therapeutic, I guess you'd say.
That's right.
So with that, guys, where can my audience go and find more information about Accretive Wealth Partners?
Well, we have a website, accretivewealthpartners.com. We have a blog on that website where we write stuff. We have a mailing list that they can sign up for if they just want to shoot an email to Gary or Eric at Accretive Wealth Partners. You can be on the list for our quarterly letter and other stuff that goes out. We have a LinkedIn page. If you follow us there, we post stuff. Where else, Eric? Did I hit them all?
Yeah. If you want to have questions, you want to go talk to us, send us an email, give us a call. Contact information is on the website. We're always happy to talk to folks.
Perfect. And do we have Twitter accounts too? Because I know a good amount of our audience also is on Twitter.
No, we don't have a company Twitter account. We don't have. Not tweeting on. We're kind of lurkers on Twitter where we follow people, but we don't have an account.
All right, so I'll promise not to expose your lurking accounts.
That's right.
Well, with that, guys. Yeah. Sorry.
No, go ahead.
I was gonna say, with that, guys, thank you so much for joining me today. I really do appreciate it. It was a lot of fun, and I look forward to our next chat. And just like I said, we're starting a show soon, so let's get after it.
Oh,
Thanks.
great!
Yeah, we really appreciate it. Thank you.
Thank you.
Yeah, thank you for having us. This was fun.